Is it better to hold individual banks over ETFs? What about covered call ETFs or ones with a little bit of leverage? Hold on to your seatbelts, folks. This is going to be a good one. Canadian banks are a cornerstone of many investment portfolios, and for good reason. They are reliable, profitable, and, well, they've weathered financial storms that left other sectors in shambles. But with so many ways to invest in them, how do you know which strategy will grow your portfolio the fastest while keeping, of course, those risks in check? There are absolutely many ways you can hold Canadian banks, and we are going to pit a few of them up against each other to see just how well they have performed over the last year. Of course, when you're putting together a bank portfolio, you can certainly pick and choose any of the banks you want with any weightings. However, if we're going to give these guys a real test, I think we need to be comparing apples to apples. And that means we should be using equal weighting. Equal weighting ensures that each bank in your portfolio gets the same allocation no matter what its market cap is. This approach is perfect for investors who want to reduce concentration risk. By spreading the risk more evenly, equal weighting can lead to better long-term performance compared to, well, traditional cap-weighted strategies. For today's test, we will be comparing holding an equal weighting of individual bank stocks against an equal weighted ETF, an equal weighted covered call ETF, and an equal weighted covered call with leverage ETF. Whew, 4 contenders, 1 winner. A sub to the channel is a win when it comes to future content. Before we get into some data, there are some considerations that I'm expecting the data to give us some empirical evidence of. That's going to be kind of cool. That first consideration is, of course, management fees. All of these ETFs will have management fees that will be chipping away at those returns. In fact, as the ETF adds more complexity, like covered calls and leverage, those management fees are going to get bigger, and this will have at least a little bit of an impact. Next, of course, regarding covered calls, there is a loss of upside potential involved. In the second half of the year, when the banks were more bullish, we will see that come into play with those returns. Finally, there is always that added risk of the ETFs with leverage, as that little extra works in both directions. So what am I expecting to see? The vanilla ETF should finish with a total return just below the portfolio of individual banks. And that strong bullish second half of the year will more than likely knock the covered call versions a little lower. I do think the leverage version will beat the normal covered call version for sure. One last thing, I will always have a few folks in the comments saying, well, that ETF would have won if you would have just reinvested the dividends, Candace. Yeah, maybe. But you know what? We're about to find out, because for this test, we are going to do exactly that. We will reinvest the dividends and put that to the test as well. In addition to that, we are going to start each portfolio with $6,000, and we will assume we are in Wealthsimple. So we have a full fractional investing and, of course, commission-free transactions. So without any further ado, let's do this. We are, of course, starting with those individual banks. So we do have $6,000, and we will split them up, $1,000 per bank. So we were able to buy 15.75 shares of CIBC, 7.46 shares of Royal Bank, 9.92 shares of National Bank, 15.55 shares of Bank of Nova Scotia, 7.66 shares of BMO, and finally 11.72 shares of TD Bank. Each of these banks, of course, then did receive 4 dividends throughout the year. So we reinvested with each payout to increase our overall shares throughout that year. So that does give us a final share total, which come in at, for, well, CIBC, we went up to 16.57 shares, Royal Bank, 7.74 shares, National Bank, 10.30 shares, Scotiabank, 16.59 shares, BMO, 8.05 shares, and TD, 12.33 shares. So in total, the $6,000 invested into these banks returned a total of $7,568.90. That is a reinvested total return of 26.15%. Guys, that's going to be the mark to beat today. In case you were curious about the individual reinvested total returns, they ranged from CIBC with a reinvested total return of 50.22% down to TD with a reinvested total return of negative 5.77%. Okay, let's take a look and see how that equal weight vanilla ETF did. For the equal weighted ETF, I chose to use ZEB, which is the BMO Equal Weights Banks Index. It has a management expense ratio of 0.28%. It also has a monthly dividend, so I had to reinvest 12 times in the calculations. Oh boy. We started with $6,000, which amounted to 170.02 shares. And after 12 reinvestments, those shares grew to 177.93 shares. So when it is all said and done, that $6,000 grew to $7,540.60, which is a reinvested total return of 25.68%. As I expected, this ETF just fell short of holding the individual stocks. Interestingly, if you add in the management fee, it takes you up to 25.96%, which is still 0.19% lower. And in my books, I would say that easily falls within a typical standard deviation. Okay, let's add some covered calls and see what happens. So for the covered call equal weighted ETF, I chose to use BKCC, which is the Global X Equal Weight Canadian Banks Covered Call ETF. It has a management expense ratio of 0.49%. It is higher as we expected. This one, of course, also has a monthly dividend. So once again, I had to reinvest 12 times into those calculations. So as before, we did start with, of course, $6,000, which we were able to buy 423.73 shares. And after 12 reinvestments, those shares grew to 481.12 shares. This means that the $6,000 grew to $7,120.60, which is a reinvested total return of 18.68%. Holy banana bread. We can easily see that the loss of upside potential is a very real thing with this ETF, as those nice 15-cent per share monthly dividends were just not enough to mitigate the losses in upside potential. I will admit that was a little bigger than I was anticipating. All right, let's look at the covered call equal weight ETF with leverage. For this one, I chose to stick with BKCC, but the BKCL version, which is the Global X Enhanced Equal Weight Canadian Banks Covered Call ETF. It has a management expense ratio of 2.16%. So, yep, we definitely are seeing a big jump there. Like BKCC, this one is also a monthly dividend, so I got to reinvest 12 times as we were pulling these numbers together. We started with $6,000, which amounted to 315.79 shares, and after 12 reinvestments, those shares grew to 368.87. This means the $6,000 grew into $7,329.40 with a reinvested total return of 22.16%. This one experienced that same loss of upside potential, but on the flip side, the leverage helped a good amount to get their reinvested total return a little higher. Not high enough to challenge, but I do suspect that if we had had a year with more sideways and maybe a gentler upward slope, this one could have challenged for sure. These results were what I was expecting, but the surprise was in how much better the individual stocks in the vanilla ETF did over the covered call and leveraged versions. I expected them to win, but with a closer margin for sure. So what does this translate down to for individual investors? I do think it provides a good argument for an equal weight bank ETF, even though technically the individual stocks won. Holding and managing 6 stocks is a lot more of a time commitment than an ETF. And for some investors, that time is worth the management fee for sure. Even though the covered call and leveraged versions finish lower, they are still strong options for income investors. If you have a retirement portfolio that is geared to pump out dividends to supplement your retirement, these are ETFs you want to consider in your research. If you are interested in any of the banks or ETFs we looked at today, don't forget to put in a whole heaping helping of due diligence before you place any of your hard-earned money on the table. Let's continue that learning journey by checking out this video on BMO. Thank you for watching, and I will see you in the next video.